talking about the whole concept of choosing the right SIP, Sahi SIP that is. Hear out some more opinion from the mutual fund industry, some more expert opinion from the mutual fund industry on how you should be going about your SIP investments.
You can enter the market when you have money. If you don't have money, no matter what kind of market it is, you'll never be able to invest. Second, timing the market is very, very difficult. The world's best known traders have very limited chances of success. For an ordinary investor, they should remember that trading is injurious to their financial health. It's time in the market which makes money for you. So be a regular investor, don't invest in lump sum, invest on a regular basis, maintain your asset allocation discipline, don't chase momentum, invest looking at the valuation. That combination will create far better product for you. Today, fortunately, mutual fund industry has created balance advantage fund category where fund managers take call looking at the valuation of market between debt and equity. And that product also should there be in part of every investor's portfolio. Please remember why you are investing. Is it for your retirement? Is it for next year's holiday? Depending upon your end objective, your construction of portfolio will be different. Second, do remember, utavle amba na pake. Mango can't grow overnight. Mango can't grow in a hurry. It takes time to generate return. So you have to be patient, you have to be long-term investor. Third, tipe tipe sarovar bharai, bund bund se hauj banta hai. It's the small amount of savings invested in a disciplined manner over a period of time which creates wealth. The markets are good for meeting your need, but they are not good for meeting your greed. So please differentiate between your need versus your greed. Essentially, for investors to make money, the mantra remains same. Be a regular investor, be a disciplined investor through asset allocation, and be a long-term investor. Don't become investor because your trading bets have turned into losses. Don't end up losing being an investor because someone else made money through trading.
The recent correction in mid and small caps has a specific reason to it, that the previous year, right, I think there was a lot of money chasing mid caps which went into that asset class category and took up the valuations, and then the SEBI regularization scheme meant that a lot of funds had to liquidate their mid and small caps. So it's a very temporary phenomenon, and ultimately if you see over the long run, we have done some studies. One is that whenever the economy does well, it is the mid and small caps which benefit. Second is that if you have a 5-year outlook, even in mid and small cap mutual funds, you have never lost money when you have stayed for 5 years. The third is that India is on the cusp of a long-term enhancement in the GDP growth rate from 7 or 8% to 9 or 10. Second, the demographic dividend, as the younger Indians come to work, is that the per capita GDP of our country is slated to double over the next few years. So I think the overall, the consistent SIP method of investment into mid and small cap means that over the last year actually you acquired more units during this period, which will come to your benefit in the long run. So my recommendation to those who have excessively, as you say, invested in mid and small cap is to continue that investment and not worry about the short-term repercussions, but in the long run, mid and small cap funds have delivered 3 to 4% alpha over large cap funds in the Indian economy. I think for 2019, given that bang in the middle of the year we have a general election due, would be to balance the portfolio into 40% to safety and to 60% into risk. When I say safety, I'm talking about partly into large caps, partly into consumption and consumer durables and those kind of things. And when I say long-term investments in terms of taking a little more risk, I mean the capital goods sector, because as you know, capacity utilization has been rising, and in the second half of this year we expect a strong rise in the capacity creation process in our economy. So I would recommend that investors maintain a 40-60 balance between safety and risk during the current year in terms of their portfolio allocations.